Well, futures slipped this morning ahead of the stock market opening for the week. They also indicate that the major indexes will continue their downward spiral. S&P 500 futures dipped about 0.7%, and Dow Jones futures dropped 0.5%. CEOs are making more than ever before. The median pay package in 2021 jumped up to $14.7 million. That's according to analysis from the Wall Street Journal. Most saw an increase of at least 12%, setting a record for the 6th year in a row. And when the market opens today, many are worried that it will continue to drop toward a bear market. That is when markets fall 20% or more from recent highs. Now, this wouldn't be the first time the U.S. has experienced one. A new article from Barron's looks into past bear markets to give us an idea of what could happen in the near future. So Ben Levisohn, deputy editor of Barron's, wrote that article and is joining us now to explain things. Ben, thanks for joining us. The best predictor of future behavior is past behavior. I believe I learned that from Dr. Phil, but apparently it applies to the stock market as well. What have you learned?
Well, I mean, with so much of what happens in the market, we can find analogs in the past. The bad news for that is that there are a lot of different things that we can compare it to. And so there are people that we call bulls who are very optimistic about the market and bears who think that it's going down. And they're always looking for history to back up their views. Right now, we're in a kind of moment where it's really hard to know which one is right. The market has fallen, the S&P 500 has fallen almost 20%, which would be characterized as a bear market, but not quite. And the stock market does this actually quite a bit. There have been a number of cases where it falls almost 20%, almost into that bear, but doesn't quite get there. And in those cases, you can often get a nice bounce in the stock market. The problem is we just don't know if this is one of those cases. I think the good news, though, is that the market is a lot cheaper than it was at the start of the year.
Right. So that means I guess some people could benefit if you know how to play that, how to invest. What can individual investors do to protect their investments?
Well, I think for most of us, the protection comes almost beforehand. When you hear people getting really excited about the market and talk about how it never goes down, and you have to start buying these stocks when your cab driver is telling you about stocks, that's the kind of moment where you want to say, hey, you know what? I think I need to be a little more cautious. Mm-hmm. We're actually in a moment right now where probably the best thing to do is to take a look at an asset allocation and make sure that it's the right one for your age group. So if you're someone who's fairly young and just starting to invest, you have a very long time horizon. And this pullback might not be a bad time to start actually putting a little more money into the stock market. But the older that you get, you have to be a little more cautious. But there's still that kind of rule where you take your age and you subtract it from 100, and that's the percentage of stocks you should have in your portfolio. Mm. And so, for someone like me who is now almost 50, I want to have half my portfolio in stocks and maybe half in bonds, and you can play around with that number, but it's a time to make sure you have that allocation right.
If you're not invested at all, could you still feel the impact of this market?
Sure. I mean, I think one of the things that we've seen is that this has really changed the way companies are going about allocating money. There were a lot of companies that right after the pandemic, especially a lot of the hot tech companies that we were talking about during that period, things like Zoom, Amazon, they were hiring a lot of people, and they might have hired too many people. They might have built out too much infrastructure. And it's still up in the air whether companies are going to have to dial that back a little bit, where they hired too much and built too much for the economic environment that we're going to have. For now, though, it really does seem to be primarily a market event where the market is adjusting from being quite expensive at the beginning of the year to more moderately expensive now, though not cheap.
Ben, thank you so much.
Thank you.